What's up, everyone? It's Karthik with MoneyVest. So Tom Lee was on CNBC just a few minutes ago. So this interview just ended less than about 30 minutes ago. So I had the time to essentially go over it and take some notes and break down exactly what he said. And it's actually, to my surprise, was word for word what I've already addressed in my previous videos. This is actually no kidding. I mentioned this in the last two updates that I've sent out on YouTube. This was from the long weekend. And I talked about how there is opportunities coming and be ready for when they get here, right? When the markets actually give us those buying opportunities, be ready. And this right here is the video that he essentially had on CNBC. So he was there today earlier. Investors should be cautious for the next 8 weeks. And he's actually expecting some market turbulence with about a 7 to 10% correction in the markets in the next 8 weeks here. So this is actually quite interesting because, as we know, that Tom Lee tends to be a little bit more of a perma bull, and since 72 to 85% of the times markets tend to move higher depending on the different time frames that you're looking at, he is obviously more right than wrong because markets continue to push higher as there is earnings growth, productivity growth, and markets tend to, on a long-term basis, keep pushing higher. But I think it's really important to take note when Tom Lee is actually sounding cautious or sounding the alarm for us to be a little bit more careful. However, he also does mention that there is going to be a buying opportunity for all investors to once again go long. A lot of that's going to depend on what happens with the jobs report that comes out later this week on Friday, as well as the Federal Reserve's meeting on September 18th. So the rate cut is very much priced and baked into the market here. So definitely do check out that video if you have the time. But this right here are some of the more important things that he discussed. And those are a lot of things that we have already talked about on the channel before. I've mentioned, be ready, be prepared. I'm raising my cash exposure once again to get ready to buy another potential correction or pullback in the markets, considering how elevated we are from a earnings standpoint, from a valuation perspective, as well as from a technical analysis standpoint, not to mention the MoneyVest index, the volatility. Everything is really suggesting for some pretty extreme readings that we are getting in the market. So market growth fears will persist, and the market cares more about the unemployment rate and the initial claims, as we have already discussed. A lot of that, the markets are really fixated on where the unemployment is, because that's really what's going to dictate whether we get a higher rate cut, in other words, a more aggressive rate cut, or just about a 25 basis point rate cut, or if the Federal Reserve is going to backpedal that rate cut altogether if these strong jobs reports continue. So this jobs report will be a nice strong bounce back higher, is what Tom Lee mentioned. But he also said, but hopefully it's not too strong, because that might force the Fed to backpedal on rate cuts. And that's actually quite interesting because the Federal Reserve is in a very, very tough situation, tough position. And Jeremy Siegel from Wharton also mentioned that the Federal Reserve is really risking, the economy by not cutting rates sooner, because they've already missed the boat. In other words, they're a little too late in cutting interest rates, and they're really just playing with fire to let the economy go on for a little bit longer to see how far we can go with these higher interest rates. And then they're going to finally make the decision of cutting interest rates. So it's kind of an interesting situation for the Fed, because if the jobs report comes in too strong, right, that's good for the economy, but that's really going to force the Fed to reevaluate, right, how the situation is with respect to the economy, with respect to spending and the consumers and all that stuff. And that's going to really force the Fed to maybe backpedal on rate cuts altogether, which is obviously going to create this market dynamic where the markets will have to reprice interest rate cuts out of the markets, and that won't be good. But of course, if you get an unemployment rate which is accelerating higher, so 4.4, 4.5, if that starts to get worse, that may not be great news for the economy, right? Because that's going to be signaling more, probabilities of a potential recession. But it's going to be good news for the market and for the Federal Reserve, because then again, we'll be pretty much locked in on at least a 25 basis point cut, if not more. He also goes on by saying that investors should be cautious for the next 8 weeks. So 8 weeks, in other words, 2 months, September and October. Our seasonality analysis tells us that September, towards the last week of September, tends to be more severe in terms of the market sell-off, and October tends to be a bottom for the market, as we have already witnessed in the last 3 to 4 years, and even going back further. And also in an environment where summer, July through August, we are up 5% at least, October 18th to October 28th. So those are the 10 days that actually tend to be more brutal because there's been more times we've been down in those 10 days than we've been up. In fact, I think that ratio is about 4 to 18 or 4 to 19. I think something like that. We broke that down in our yesterday's video, so definitely do check that out. But he's essentially cautioning investors to be careful for the next 8 weeks, and markets have been up 7 of the 8 months, so it's an incredibly strong market. The next 8 weeks, people get a chance to buy. Just be ready to buy that dip, something that I've mentioned in my previous updates. And two things that they are watching very closely, that's front strat, is Bitcoin and energy. Bitcoin for risk on and risk off environments, and energy for election outcomes. And 7 to 10% correction is possible. That's what he mentioned. I think that was quite the headline there, with a 7 to 10% correction, according to Tom Lee, is possible. And we should expect market turbulence. And I think investors will get a buying opportunity. 5% pullback is very likely, and we'll find out more from the jobs report. And I'd be buying that dip on Friday, is what Tom Lee essentially mentioned. This right here is another really interesting chart that I want to go over. So we cover the price to earnings multiple, but Charlie Bilio is talking about the price to sales multiple for the S&P 500, which I think is also really important for us to look at, because right now we're trading at 2.9 times sales, and that's nearly double the historical median and approaching its peak valuation from fourth quarter 2021. So if you take a look at where we were at 2.09 during the 2022 sell-off. That's where we kind of bottomed out, and we were at well over 3 in the beginning of that sell-off of 2022, and we were at just over 3.04 at the end of 2021. Right now, as it stands, we are at 2.93. which again is almost double the historical median and average values for price to sales. Price to sales is nothing but the overall market cap of the S&P 500, which I think is sitting at just under $50 trillion. And the sales generated by all the companies, right? All the companies that are part of the S&P 500. So, we're looking at what? $50 trillion in market cap. And again, we're at about 2.93. So again, you do the math here. So 50 divided by 2.93, we're looking at about $17 trillion in sales for S&P 500 companies, right? Because S&P 500 companies right now are trading at 2.9 times. That's a multiple of their sales, right? Because that's the collective valuation of S&P 500, which again, you'll notice is a pretty extreme level altogether. We can also look at the price to earnings, which is now at over 23. So we're in the 90th percentile at the moment as well, based on those valuations. And this right here is Ryan Detrick also suggesting that September 2nd, 2023, September 2nd, 2024, the S&P 500, both years were up well in the double digits, 17 to 18%. And last year and this year look a lot alike so far, and really suggesting for the idea that September may not be the best month for the market, September and October, where we do see a little bit of weakness here. But again, going into the last quarter of 2024, especially when you consider election outcomes in November, could be a very, very strong time to be a buyer in the market, and of course trading to the long side, where we can see a very blowout close for the markets altogether. So there's a lot of essentially there's a lot of consensus, basically a forecast that September, October, and now we've even gone Tom Lee on board with that same type of analysis as what we've talked about from a seasonality perspective, that things can get turbulent, volatility could be higher. Markets can see a little bit of that pullback or a dip anywhere from 5-7 to as much as 10%, and that's only going to create buying opportunities. And I really want everybody watching this channel to be prepared, right? To be ready for when we do see one. I'll keep you guys updated with the MoneyVest index, with volatility, with different percentiles and different things that we're looking at from the MoneyVest dashboard, to then take advantage of those dips and of course close out the year fairly strong after the election. And again, November, December being one of the strongest months for the markets altogether. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel. Also share these videos with your friends and family, other traders and investors that can benefit from the message of these videos. And as always, happy investing. I'll see you all in the next video.